Hi, hello. So we are doing portfolio management. In this portfolio management, the new reading that the CF Institute recently added is behavioral biases. Now, behavioral biases in bits and pieces, you've also seen that in equity investments, but somehow I fail to realize why CF Institute has added that into portfolio when there are already 7 topics. But yes, behavioral bias is a complete theoretical topic, and this topic has been moved from level 2 to level 1. So you also see that coming up again. Now, from the exam point of view, I'm not expecting too many questions from this, but I'll explain here in detail what are the different biases. Before I begin, many of these biases you will find very confusing. Many of them are overlapping or repeating. But I'll give you the hint that I've made the notes in details so you can go through it and you can understand in details with examples. But my suggestion would be just to focus on the keywords. So from the name, try to capture the keywords because that's what you'll remember. Okay. So let's start with behavioral biases of individuals. What are we dealing here? We are dealing with that when an individual investor, when he or she invests, they do not always apply a rational thought process. They have some behavioral biases. What are behavioral biases? What are different types of biases? Can we manage it? Can we overcome it? All that we are going to learn. Right now, in front of you, you have the index where I'm going to first cover up the cognitive errors and emotional biases. We have to understand the difference between two. Within the cognitive errors, you have belief perseverance and information processing bias. We're going to learn about all of them in a while, right? And then the most important part comes the emotional biases. After understanding the emotional biases, we'll understand the effect of this bias on investments or your investment decisions, right? So let's start with the behavioral biases. So first thing I'm going to make you all understand the difference between cognitive and emotional biases. But before that, what is this behavioral finance and why is behavioral finance so important? Let me tell you that this is going to be very important in your level 3 as well, because in real life, when you're going to manage portfolio, you're not going to meet clients who have rational thought process. Clients do have reactions which are based on situations. In fact, you yourself as an investment manager may react differently when it comes to your own investments or your client investments, right? So behavioral finance is the research which has gone through the human behavior, which is very different compared to the traditional investments, compared to the traditional thought process, where people are assumed to be behaving rationally. So it is a research of the ways in which human behavior differs from the rationality assumed by traditional economic models. Remember, the economic model in equity assumes CAPM and all these models, CAPM and all these models, they assume investors are rational, means they are risk averse, but in reality, they are not always. So if they are not risk averse, what they are exactly, we'll see that. These irrational behaviors may lead to predictable deviations of financial markets from the equilibrium or market efficiency. So why are markets not efficient? One of the biggest reasons of markets not being efficient is investors' behavior, their reactions, their errors with respect to not being rational. That is what behavioral finance is. Two forms of behavioral biases, as I said, cognitive errors and emotional biases. From the name itself, you should know errors means they are mistakes. Biases means your thought being stuck to something, right? So cognitive errors are due to faulty cognitive reasoning. Cognitive, the way you understand things. The solution is that yes, they can be corrected or eliminated through more information, education, isn't it, or guidance. But emotional biases are due to feelings or emotions, and they are very difficult to correct. They are impulse behaviors. They are very spontaneous reactions. So you can't actually, correct them, but you'll have to, somehow accommodate that in your portfolio decisions, right? They arise spontaneously rather than conscious efforts. That's the problem with emotional biases. So by now you must have got it that emotional biases are more difficult to overcome. So let's first understand cognitive errors. Cognitive errors itself can be classified into two things: belief perseverance and processing errors. Belief perseverance means you have some belief which you are stuck at. You're clinging upon a previously held belief and you're finding it difficult to change. You're not changing it. You're not taking up new information and processing it, right? Now, this again can be due to your inability to do that or because you do not have enough guidance. Processing error means that you are taking the new information but not being able to process it and use it logically. So information may be processed and used illogically or irrationally in decision making. So belief perseverance, not taking the new belief, right? Processing means even if you've taken the belief, you're not able to use it properly, correct? Within both of these categories, there are several biases, 5 to 4 biases. We'll see all of them. Let's first deal with cognitive errors, belief perseverance. Within belief perseverance, we have 5 biases. So let's start cognitive errors, belief perseverance. As I said, belief perseverance refers to a situation where an individual is not changing his or her belief. So what happens here? They hold beliefs which are conflicting. They do not accept the reality, right? It refers to a situation where individuals have a conflicting beliefs which they hold. It causes stress that individuals intend to reduce by letting go conflicting beliefs. So you don't want to take the stress of a belief that you are not comfortable with, so you perhaps try to ignore it. That is belief perseverance. You are not changing your belief. Within belief perseverance, the first is conservatism bias. As the name suggests, you're quite conservative and reluctant to change. So market participants rationally form an initial view. So when you invested at that time, you probably saw CAPM or other models, valuation models, and you did decide and picked up the investments carefully. But then as the new information came in or the information changed, you fail to change because you're too confident on your previous belief. Individuals overweight their prior probabilities and do not adjust them appropriately as new information becomes available. This is what happens when there is a conservative bias. Now, how do I identify? There are signs. What are the signs? Individuals try to maintain prior forecasts and security allocations, so they do not adjust to the new information. The biggest example of this is when you're holding your positions for too long without rebalance. You're not changing your asset allocation. You're keeping it as it is when you bought. So that is what is conservatism bias, not ready to change. That is conservatism bias. Confirmation bias, on the other end, is that very interesting. You've already made up your mind and now you keep on confirming it, right? So market participants focus or seek information that supports their beliefs and avoid conflicting beliefs. Consider positive but ignore negative information. So let's say I've already decided that I want to defer the exam. Okay, I get most of the students these days saying, oh, can we defer the exam because the CF Institute has provided the option. Now they have already decided that they want to defer the exam, but now they keep on confirming. They ask people that, you know what, deferring exam is better, right? Better, right? Better, right? They keep on doing it. They ask me questions that, why am I deferring? They're trying to justify me because they want to get a confirmation from someone that yes, they've done the right thing. Okay, that is confirmation bias. You want the positive view only. What are the signs? You become overconfident about your correctness of the decisions, set up decision process incorrectly to support your preferred belief. So you have made a decision process convenient to your belief. The examples are reading articles about recently bought stock to support and confirm your decision. So you have already bought a stock and now you always look out for news which are positive for your news. And that's what you feel confident. Wow, I did a great job. You know what? I did a right job by buying the stock. You're perhaps ignoring anything which is against your stock, right? This is what is called confirmation bias. Now comes slightly bigger thing, representative bias. Errors of believing that because two things are similar in the same respect, they are also similar in other respects. What does it mean? We will see an example, right? The two forms of representative bias are base rate neglect and sample size neglect. Sample size. First of all, two things are similar in some respects. Therefore, we believe that they are similar in other respects also. What does it mean? Basically, we'll see an example here in base rate effect and try to understand it. What are the signs? The sign is that it leads too much importance to few characteristics based on a small sample size. So based on some small characteristics, you make up a big judgment or make decisions on two simple rules instead of thorough analysis. So what is base rate neglect? Still, I'm sure you may not have got what exactly it is. Analyzing individual member of population without considering properly its probability. Example, even if the percentage is not high, the absolute number may be much higher. Does it happen? Even if the percentage is not high, the absolute number may be much higher. Remember, this very much happens in the coaching industry, the training industry. Those small institutes which have, let's say, 4 or 5 students, they always say, oh, our percentage result is high. I recently saw a post by one of the institutes saying that, I think they had only 3 or 4 students and they said, oh, we got 100% result, right? Well, even for a proper sample, we need 30. And the large institutes, they probably may have less percentage of students passing, but the overall total number of students passing may be more, right? So just by concluding that, oh, the passing percentage is high, therefore this class is performing well, that is what is called representative bias, where because some things you found similar, you found it similar in other aspect also. Here, I mean that if you found that, the passing percentage is high, but you forgot the fact that it's only 4 students, you assume that it will be higher for 1,000 students as well, which is not a fact. Clear? Sample size neglect. Sample size neglect means the sample which you have chosen for your decision itself is incorrect. Classification of decisions are a very small and unrealistic data. Hiring a fund manager just on the basis of his or her recent 3-year performance, right? So you're betting on the fund manager for long, but you've just seen the recent performance. But in the longer trend, she seemed to have underperformed. That is small sample size to make a big judgment. That is sample size neglect. So representative bias means because something happened, you assume something else will also happen. Because the probability of the passing rate is too high for a small amount of people, you assume it will be high for large amount of people. Sample size neglect means because the recent 3-year performance is great, you assume the 15 years performance will also be great. That is representative bias. Clear? Next comes illusion of control. You feel you control the outcome, but in reality you don't. Market participants wrongly believe they can control the outcome. Again, this is also included in emotional bias, where you have lack of knowledge and self-attribution. Means basically you feel that you've done the right decision and you know the outcome more than another. This is very much common for people who work in the same company. For example, let's say I'm working in a Microsoft and I probably think I know more about Microsoft, so I bet on the stock, right? You overweight securities which they feel they have a control on the outcomes, leading to inadequate diversification. Research analysts believe that they can cause a big difference in the market with their reports and influence the market participants because of their recent success. A lot of analysts feel that, because of my report, there is a buying in the market or selling in the market. That is illusion of control. You feel you can influence something much bigger. In reality, it may be just a coincidence. Okay. Hindsight bias is selective memory of the past. Oh, you recall only what you want to recall. You recall only good things about you, not bad things, right? Actions leading to tendency to see things as more predictable than they really are. What are the signs? Can lead to overconfidence in ability. You're not focusing on the techniques of valid research. You just saw something and you probably make a decision. And basically you don't go in detail of analyzing it. You feel, oh, I know everything. So that statement, I knew it all along, I know everything, these statements are probably signs of that you have not gone thorough, and they probably will lead you to, inefficient portfolios. They probably will lead to a situation where your portfolios are not diversified. Correct. So hindsight bias is where you only recollect few things and make up your decision. That is hindsight bias. Correct. Now we were doing this cognitive errors belief perseverance, where you are having a conflicting belief. The second type is cognitive error information processing bias. Means here you are ready to change the belief, but you are unable to because you are wrongly processing the information, or because you do not have the ability to do that. It causes stress that individuals intend to reduce by letting go of conflicting beliefs. It's the same thing out here, but again, your situation is that you are wrongly processing the information. The first cognitive error with respect to information processing is anchoring and adjusting. Anchor is something on the ship. You remember, on the ship there is an anchor which holds the ship to the dock, and then the ship, even if it is floating around that. Correct. So for example, how does this work here? For example, let's say recently couple of months back I saw the inflation data as 3%. So I still feel that the inflation should be around that only because that was something that I recently saw, or that's a long-term average that stuck in my mind. So basing your expectation on a prior number and overweighing its importance. So any adjustments that you make are around that number, right? So making adjustments in relation to that number as new information arises, it leads to underestimating the implication of new information. Being stuck to some old number and adjusting it, that's the sign. Making estimates of EPS relative to the previous value. For example, many people do, right? Last year's EPS they compare and they say it's not wrong, but they say that no, that is where the long-term EPS should be. Correct. So you are basing your value on something that you probably think it should be around. That is anchoring and adjusting. Now comes mental accounting bias. Mental accounting bias is where you treat mentally different assets differently, even if they are the same thing. You don't have a total portfolio approach. It occurs when money in different accounts or form different sources differently when making investment decisions. The sign is that portfolio is not optimal and you can hold positions. It can cause investors to hold positions that offset each other rather than considering investments from a correlation point of view. What do I mean by that? Here, very nice example, investing of bonus that you get from the company. It's a one-time big amount, right? Most of the people do, what do they do with bonus? They put up in stock markets, or they pay off their debt, or they buy real estate. In fact, many people buy real estate or big investments with that bonuses. They invest, they take risks. Okay. But what if instead of bonus, you may have probably got the property from your father or from your relatives? That is inheritance. Inheritance money, people don't bet. Inheritance money, people try to secure. So the inheritance amount investing in risk-free, that's what people do. That is called mental accounting. So you treat different types of money differently. Got it? Right? So just say, imagine if a company gives you a yearly bonus, right? The first thing you're going to probably do is that take a trip. You're not going to save it completely. You'll try to spend big or invest big, whatever it is. That is what people do it, rather than increase in salary is what they will have a different treatment, but bonus they'll try to spend off. Okay. Now comes framing bias. Framing bias is one of my favorite because this is how the media works. You know what media do? They probably ask the question in a manner that you have to answer it that way. So decisions are affected by the way the question is framed. Again, the sign is that portfolio will not be optimum, and the question is phrased, the way the question is put up can influence your decision. The very good example I've given here is, suppose vaccine A is adopted, 200 people will be saved. But if vaccine B is adopted, there is 1/3 probability that 600 will be saved, but 2/3 probability of others will not be saved. So 1/3 probability out of 1/3 probability of 600 will save. Even that comes to weighted average of 200 only, but that scares you out that 2/3 will not be saved. So most of the people, even if the weighted average is same, they will choose option A because option A says 200 will be saved. So the way you put up is what it makes difference. You know, I watch a lot of media these days. The media has decided whether they want to punish the government or they want to take the side. So they ask the question in the same manner. They ask, oh, don't you have problem with the government? Is everything okay? Are you happy? They keep on pushing it till they probably, get the answer that they want. Or they may say that, "Oh, haven't you been happy? What's wrong? What's problem?" So they basically want the answer that they want to hear, and they'll keep on dragging you with those questions that eventually they get the clip that they want. That is what framing bias. The way you put up things is the way you answer up. Okay. Availability bias occurs when individuals judge the probability of an event occurring with ease. So whatever easily is able to recollect, whatever is easy to do, that is what we make our conclusion on. Putting undue emphasis on information that is readily available. Too much bias, you are against the easily available information. Too much significance or high probability to recent events and past events. So this is a very good example that I picked up, that suppose I tell you to think of the word starting from R. Starting from R. Rat, rabbit, roll, round, ribbon. Correct? So many words. Rich, rural, random, rise, red, roar. So many words, right? Which starts with R. But if I tell you, think of the total number of words which start with R as the third letter, then you will say far, then you will say fire, but you'll have to keep on thinking, right? In which one third letter is R, isn't it? It's more difficult than remembering the first letter. So most of the people will say, oh, there are more words with first letter as R instead of third letter. But the reality, the dictionary says that, in fact, there are actually 3 times more words with third letter as R instead of first letter. Got it? This is what happens. So what you easily recollect is what you base your decision on. That is called availability bias. So this is what we discussed with cognitive errors, information processing bias. And before that, we understood belief perseverance. Okay, both the cognitive errors, they cause stress, and you probably want to, ignore them, but they can be corrected with more education. Okay, now let's understand emotional biases. They generally arise from emotions and feelings rather than conscious thought. Remember, emotional biases are difficult to overcome, okay, because they are reactions. The most important and most famous emotional bias is loss aversion bias. By the way, this is what we also covered in equity. I'll directly go to the example. For example, if I give you 2 games, in game 1, if you win, you'll get 100. If you lose nothing. But in game 2, if you win, you'll make 200. And if you lose, you'll have to pay 100. And the outcome of both is 50-50. Which one will most of the people choose? They'll choose game 1. Why? Because it has nothing to lose, and if you win 100. But what if the probability of both the outcome is 50-50? Then in reality, if you take the weighted average of both, it's going to be 50. Just see 100 into 0.5, 0 into 0.5, and in the second one, 200 into 0.5 and minus 100 into 0.5. The weighted average of both is same, but because you saw that minus 100, you got scared. That is loss aversion. Here, your reaction is asymmetrical. It displays asymmetrical responses to gains and losses of equal amount, feeling more pain for a loss than the pleasure for the same gain. The consequence is that you are jittery in the sense that you trade too much, and whenever there are short gains, you try to immediately book profit. But when there is loss, you hold on. Most of the people don't want to take the loss, so they hold on the position and they say, you know what, I'm a long-term investor, I'm trying to average out, isn't it? Right? Taking too much risk by continuing to hold assets that have deteriorated in value. No people like selling assets which they had bought at 1,000 and now they are at 100. People hold it, but if there is a small gain, they can't hold it. They just want to book it because they are scared. Right? That is loss aversion bias, the most common bias. Overconfidence bias, do I need to say that? It occurs when market participants overestimate their own ability. I already knew it. So, unfortunately, this so happens that those who pass, they say that, yeah, I was anyways going to pass. But the reality is that, of course, your hard work is there, but overconfidence at times. And most of the people do it after they pass. But while they're going for the exam or after the exam, they're like, oh, I'm not sure. So overconfidence bias is overestimating your own ability. Cause market participants to underestimate risk, overestimate return, and definitely fails to diversify properly because you're overconfident. You hold on the positions. Illusion of knowledge bias. The statement can be, I predict better than others. I have more knowledge than others. Right? Self-enhancing means you give yourself more credit and blame others. That is self-protecting. So giving credit for all good things to you and blaming for all others for anything that goes wrong. That is all the signs of overconfidence bias. Then comes self-control. Self-control is where individuals lack self-discipline and favor short-term satisfaction over long-term. Most common with all those investors who feel dividends are better. So they force the companies to pay dividend, but they forget the part that in the long run, the more the company pays dividend, the lesser it has retained for growth, right? So there's a belief that favors small payoffs now at the expense of large payoff in the future. So people choose dividend paying stocks more than the growth stocks. Till date, people do that. They value dividend more than the growth. They forget the point that dividend is nothing but your money back to you, isn't it? That is self-control bias. Status quo bias. Status quo means not changing, like a conservative bias, but this is emotional. Individuals feel comfortable in the existing investment strategy and don't wish to change. They hold portfolios with inappropriate risk and not considering to diversify, right? Most of this happens with buy and hold or no rebalancing, especially when the weights have changed significantly. People are reluctant to change the weights. They keep it as it is. They are more passive kind of. So they are status quo bias. You don't change your portfolio once made. Endowment bias is where an asset is felt to be special or more valuable. For example, let's say you inherited something from your forefathers. You're not going to sell it, even if it is worth selling, right? Very common with inherited assets, investors are sentimental about their investments, right? For example, your forefathers' property or some paintings, you don't want to sell it, or picture, you don't want to sell it, whatever that, thing would be, even if it makes money, you don't want to sell it. Not selling investments made for children, even when they are in dire financial need. So this is very common. That's why, many people are suggested to do investment for their children, because in any situation, they'll not break this investment. They'll compromise on their holidays or their luxuries, but they'll not compromise on the child's investment. This is very common. That is endowment bias. You are emotionally and sentimentally connected to the particular asset. Now comes regret aversion. You don't want to be left out. That is regret aversion. It occurs when participants do nothing out of the fear that my action will go wrong. So even if the markets are at bubble, you don't sell it because you're worried that what if I sell it and I'm wrong. Are more concerned with errors of omission, doing something that will go wrong. Then errors of omission. What is error of omission? Avoiding to do something, right, that will turn out to be right. So you do not want to do something which is against everyone, Instead of that, compared to that, it's always easy to not do when things are right, compared to doing something which is against everyone, which is that may turn out to be wrong. For example, most of the students in after their schooling, they choose a course which everyone is choosing. They probably are reluctant to do something new. Of course, now things are changing, but I remember that since everyone around me was taking finance, I took it because I thought that I don't want to be an outlier. I don't want to do something that no one does. That is regret aversion. Don't tell me you all did CFA because of that, because everyone was doing CFA. Oh, I should do CFA. No, don't do that. If you're doing it, it's not a problem, but do it because you want to do it. You want to learn it. You want to make value addition to your course, your career, your future, right? And CFA will make that happen, because the journey that you take is more important, not the result always. Herding behavior, people choose what is more popular, not joining a startup or a foreign firm with the fear of it going wrong. That is error of commission. Investors not buying riskier asset at all. That is error of omission. When everyone around me is buying cryptocurrencies, I somehow don't want to buy it because I think I have lack of knowledge, and also because I don't have enough experience, and I don't want to lose money. So investors not buying riskier asset, not to experience the regret when they decline. That is regret aversion bias. You're more concerned about how it will look like. That is what is regret aversion bias. Clear? Okay. Now, as I said, there are too many biases, so you'll have to focus on the keyword. Now, there is very important element here, that most of the reason behind market bubbles means when the market is speculating, highly expanding, happens with real estate, stock markets, cryptos, currencies, everything. So after the bubble, there's a huge crash because market had heated up, right? Many analysts believe that the cause of the bubble and the crash is not because that investors behave rationally, but rather the opposite, because of their behavioral bias and cognitive errors. Especially, which are those biases which leads to market bubbles and crashes? Overconfidence. Overconfidence bias leads to overtrading, not taking risk into consideration, and lack of diversification. That is what overconfidence leads to. Self-attribution, giving more credit to yourself. Persistently good results combined with self-attribution can fuel overconfidence. As can hindsight bias. Hindsight means crediting yourself for the stocks which are going up in the bull market. In the bull market, everything is going up. So you feel that no, my stock is going up because I picked it up. This is very common. Even I had such bias. Confirmation, basically you're trying to confirm your own news. So you misinterpret them, you ignore the new information or misinterpret initial decreases in asset value as simply another buying opportunity. Many people say, oh, you know what? I am very confident that this stock is going to go up. I'm definitely going to buy more. And when the prices are going down, in reality, you're scared, but you think, no, it's an opportunity. Let me keep on buying. That is, you're confirming yourself and others that this is a good investment. That is confirmation bias. This again leads to fueling up the prices or thrashing the prices. That is what happens. Anchoring, as I said, you are stuck to a particular belief. You believe recent highs are rational prices even after the prices have actually begun to decline. So even after prices begin their eventual decline, right, you're still holding it because you think that no, this is the price that it should be, because I saw the price to be around that. So if the prices are down, you feel, oh, it is undervalued, I should buy it, because your mind is stuck at that initial value. That is anchoring. Fear of regret, those who are very skeptical investors, they hold on their positions. Again, this leads to bubbles and crashes, right? Basically, you want to change, but you're not able to change because of your reaction, your emotional biases, or because of your errors, cognitive errors. Some anomalies are exceptions there are two discussions here, halo effect and home bias. Now, both doesn't mean anything is wrong, but halo effect means investors believe that the company is growing rapidly and its stock price is growing. That means you have to buy such a stock. So investors associate rapid growth and increasing stock price as being good to own. Because something happened, something will happen, representative bias. And this may contribute to further increasing the stock price such that the stock becomes highly overvalued. Okay. This is halo effect. You basically think that, oh, the company's growth is high and therefore the stock has already gone up. But you think that, no, I missed it out, so therefore I should buy it, and people keep on buying it. So the stock prices go further up than what it is expected. That is halo effect. It pushes the positive news to more buying of the stock and more valuation. Home bias is where investors are more comfortable with and confident about their own country stocks or own regional stocks, and they feel they are more safer. So that's the way investors behave with domestic investments. They have by default considered that foreign investments are more riskier than domestic investments. So they overweight stocks in their own country or region compared to other stocks, right? Especially they've given you stocks of companies whose product that they use. So they're more biased towards that. That is halo bias. That is home bias. Right? Home bias is giving more preference to the stocks that you know or you consume, or probably your home country stocks. That is where you give more importance. Okay. Well, that's the end of this shortest topic. Again, I would suggest that try to remember from the keywords, that is more important word, and related to that the theory. Otherwise, as I said, there's too much to remember from this theory, and just whatever the notes is, go through it once or twice and try to solve some questions related to it. Hardly you're going to get one or two questions from it. So do not put too much of an effort into this, like the other topics of technical and fintech. What you're going to see, technical, fintech, and even to a large extent risk management, do not spend too much of your time in it. Just read it once or twice from what is there in the video and then solve questions. Because as I said, portfolio's weight is overall 5 to 8%. So you can expect around 10 to 12 questions, and majority of the questions are going to be from the first 4 readings, which is related to core portfolio making, calculations and all, right? So the last 4 topics, which are behavioral biases, risk management, technical and fintech, which you're going to see, in that my suggestion is that don't overdo things. Just read it once, twice and solve few questions. Okay. Thank you. Bye-bye.